computer. There we go. We are off and running, and good morning, everyone. Good to see everyone. No retirement plan webinar is possible without a disclosure. I do love my disclosures. I am Timothy Yee, a registered principal offering security and advisory services through Independent Financial Group, LLC, IFG, a registered broker dealer and investment advisor. Member FINRA, SIPC, Green Retirement, Vanderbilt Securities, IFG are unaffiliated entities. We are not talking about investments today, but as always, past performance is no guarantee of future results. And just in case anybody is wondering, we are not affiliated with HIP either. HIP Investor is a separate company, but we always welcome Paul's input. Ooh, nothing quite like a disclosure to get my blood going in the morning. Well, good morning to you, Ted. As I understand, you are the chief economist with Vanderbilt Securities. Why don't you tell us a little bit about yourself before we dive into the topic at hand?
Okay, nice to be with you. Thank you, Timothy. I'm looking forward to sharing some insights, if I can, on this war and the impacts. I am the chief economist for Vanderbilt Financial Group. That's a broker-dealer on Long Island, New York. And so I work with financial advisors around the US trying to give economic insights, talking about the market, financial markets, and everything from commodities to central bank policy, et cetera, and the impact on portfolios. I also manage a series of model portfolios in the ESG or in the impact space. So I'm quite familiar with kind of social considerations and how those flow through the investment world or the economy and so forth. So I do that at Vanderbilt. And I've been working in this area since 2008. The stock market and the economy has been a deep interest of mine. Actually, basically since grade school, when I got the newspaper of stock prices and saw that whole world and said, oh, this is very interesting. And so a long time interest there. And I also have a background in day trading. I did that for 5 years before I started working with financial advisors and the broker dealer. So that's my background.
I appreciate that. And folks, typically when we talk about war, or let's see, they've been called strategic strikes, military incursion, what typically is presented is something along the lines of this chart. And I'm going to try to bring that up. Here we go. Strictly speaking, it shows how fast the markets recover from a war. Again, you can see duration of a sell-off in some cases 3 days, 1 day, 19 days. These are very short. And so the general idea is that stay the course, invest your portfolio, it will recover. No guarantees, of course, on that. But having said that, Ted, I really just want to dive into the social impact of war. This has been going on since February 28th. And leaving that aside, what is the war in Iran costing the US if you look at it through a social justice lens? What is your take?
Yeah, I think that I think it has real and um, significant impacts that can accrue over the long run. So there are some direct impacts that could come through the increased costs of defense spending. You know, President Trump has announced that he plans to ask Congress for $200 billion in a supplemental defense spending amount. So that's a direct cost from this war to pay for the war, to restock our munitions, etc. And of course, if the war continues, that figure might go up. So that's one direct cost. And if we think about how significant is $200 billion and what does that really mean? Well, the enhanced ACA subsidies that Congress just decided to not renew for 2026. the CBO estimated the cost for 1 year of having those subsidies is $30 billion. And so we know that the CBO is estimating 3.8 million Americans are going without health care as a result of not renewing or extending those subsidies. And the cost of that, again, $30 billion per year. And when we talk about 200 billion for the war funding, then that's 6 years or more of enhanced ACA subsidies that we could have paid for had we not spent the 200 billion, assuming that does go through, which I think is likely. So that's a direct cost. Now, and that
Unfortunately, Ted, I have to update the number as of this morning. I don't know if you saw the 1.6 trillion.
what's 1.6 trillion?
That's what the administration just asked for in the proposal, if I read it correctly. And again, I'm not the economist, you are.
Oh, wow.
They
Okay.
want to slash housing, it's healthcare. Um, I, I honestly thought I misread the number.
Those are two different things.
No, no, I know they're two
The
different things, but
1.6 is the proposed budget that Trump is presenting to Congress, while the 200 billion is what they're asking just for the Iran war.
correct. But I'm just to Ted's point, I'm wondering where a good chunk of that 1.6 is going to go if we're slashing housing and healthcare. I I think you're alluding to
Right.
that, Ted.
Right. And so, yeah, we can dig in to that figure of 1.6 trillion. I didn't see that, but the general principle is we're existing in a period where there's high budget deficits every year, higher than we've seen historically during periods that were not accompanied by a recession or not, well, we are in a war, but not in hopefully a long-lasting war. And so heading into this year, the projection was for a budget deficit of 6.3% of US GDP. And now we've had the tariff ruling, which could bring the tariff revenue down a little and therefore expand the deficit as a percentage of GDP to around 6.4, 6.5% of GDP. And then when you add in the 200 billion supplemental defense spending, that could increase it to 7% of GDP. That's the deficit as a percentage of GDP for the year. So that's a massive figure. So and this exists within the broader context of just narrowing support for social programs. So we have pressure on Medicare, we have pressure on Social Security coming, we have reduced spending on areas like education, scientific research, environment. All of these things are pressured when we're spending more money on defense. So that's one direct way of looking at it, and there's a few other direct costs, and then there's some indirect costs. I know we'll get more into those
Yeah,
as we
I
move.
was I was just sort of thinking about that. If you're reducing Social Security, for example, then the consumer or the retiree has to pay more. I mean, the bills don't commensurately go down, groceries are going up. But as we think about that, people on fixed income, it becomes really quite a challenge. And maybe you can speak to higher oil prices and the impact on consumers from a social point of view.
Yeah, that's right. So if we're spending more money on oil and gasoline, and there are downstream effects because energy is an input resource and other things like transportation, so that will impact food prices, things like that. We can make some calculations, and of course, this is a fluid situation, so the war could end soon. It could go on for a lot longer. We don't know, and those calculations will change as time goes on. But so today, Brent crude oil is at around $112, and it was $66 before the war started. So that's approximately a 70% increase. Now, the price of an average gallon of gasoline in the US is up to more than $4. The latest data that I saw has it at $4.09 a gallon. That's about a 40% increase from pre-war levels. The US households spend about 3% of their income on gasoline a year. And so an average household spends about $200 a month on gasoline. And if we increase that by 40%, which has happened, that means we're going to pay $280 a month. So that's an $80 increase per month as of right now. And of course, this is only currently, that could go up or down. We'll have to see. But right now, that's a $80 increase per month. And then in terms of higher food prices, there are estimates that that could be in the order of 5% higher food prices because of the increased cost of inputs like energy. Also, fertilizer is one impacted area. And the average household in the US spends 13% of their budget on food. So if we had a $5 or 5% increase in food prices, that equates to $50 a month for the average household. So if you put those two together, that's $80 and $50. That's $130 per month for the average household that is going to go towards these essential things of gasoline and food, and then there's less money left over for other things.
Now, I'd agree with you, and I can see Rose has a question. I'll just quickly add that I recently bought 16 ounces of honey roasted almonds, $13 for the bag. Wow. Rose, what did you want to say, please, or ask?
Well, thanks for those figures, Ted. I just want to uh, clarify that when Timothy mentioned about Social Security, Social Security is not part of the discretionary budget because the money from Social Security comes from the wage earners. In fact, it's working people that are paying into it, kind of much like with a 401k. You're actually, it's like a savings for you, and so it is not a something that the government gives you. It's something that you have paid in. And the challenge, given the figures that you just gave, which I would say is probably going to be more on a conservative side, considering how the grocery prices actually go up. Um, does the government have any control over the social security payments? Because uh, I don't think they have. Uh, I I think that Congress, of course, could raise the wage cap, which would mean that there will be more money flowing into Social Security. But for the actual Social Security benefit amount, uh, I don't think Trump has can do anything about it.
Yeah, that's an obligation. I mean, Congress could change some calculations on like the cost of living adjustment, things like that to, in a sense, water down the benefits in the future, things like that. Um, so some things like that could be done. And of course they could, if Congress got together to change it in a dramatic way, that's possible. But that's politically not very popular, so that's unlikely to happen. Something on the order of watering it down gradually over time could alleviate some of the budgetary stress that's projected in the future.
Yeah,
Okay,
to
can you
that,
just clarify, Ted? And I'm sorry uh, to beat this topic because if you say budgetary constraints, because again, since Social Security funding isn't doesn't come from the discretionary budget that Congress allocates, so they like watering down the benefits is not going to alleviate any of those budgetary concerns, right? And also, I think we were initially talking about this from the point of view of Trump's proposed budget, and that he cannot cut. He cannot take any money from Social Security because it's a part of that discretionary budget. Can you just clarify that?
Right. So, I mean, that is an obligation. So we've agreed to pay those Social Security benefits, and those will be paid like for the next year or et cetera in general. Now, that exists within the whole budget framework that we have. And if, as a country, we encounter stress that we have too much borrowing, and this gets into market dynamics because the market decides as a whole when it's willing to keep funding the US government. And if it has to charge very high interest rates, that's going to be a big issue. And that's where you get the feedback mechanism in terms of pressure on Congress to change things. If Treasury yields spiked out of control, that would put a lot of pressure on Congress to change things, and then they might adjust legally the policy of Social Security.
And I popped in first a couple of things, one on the government pension offset and the windfall elimination provision, both of those which speak to the reduction in benefits that could possibly come. And then for a longer policy read, I've included the Social Security website and their comments on reduction. So ah, not a pretty picture, not a pretty picture. I mean, when I look at how much Social Security is, Ted, I just recently had a birthday. I think the projection for me is around 3,000 or $3,300 a month. I mean, it's a nice little amount, but it's not going to go very far in the San Francisco Bay Area by any stretch. One question I was curious, just tying back quickly to oil. As I understand it, the U.S. is a net exporter of petroleum products, both
Yeah.
crude oil, refined products. So with the higher prices, uh, I think you said Brent crude was at 112 this morning. Shouldn't we see some sort of benefit here in the U.S.?
Actually, yes. So there will. It's just the benefit's going to flow disproportionately to different segments of society. So companies involved in energy exploration and production, those are going to see benefit. And it's true, we are a net exporter. That's much different than, say, in the 1970s when we had a series of oil price shocks that really hammered the economy. So now we're in a better position as a country because we are a net exporter. That means many companies will benefit from the higher oil prices. That benefit can already be seen in the stock market performance of U.S. energy companies, which are up about 34% year to date as of yesterday's close, and that's compared to the broad market that's down on the year. So that's helped investors and owners of those companies. Eventually, the higher oil prices will flow through to greater investment and new wells and new exploration, more jobs like that. But that will happen gradually over time. And the hit from higher oil prices, the drag from that, will be experienced immediately, and that'll be experienced on consumers. And when you net it out, it's really the lower income cohorts that are going to experience the headwind and quickly in terms of their purchasing power and their discretionary income. And whereas the benefit will go to the wealthier cohorts. So really quite a big difference there.
Yeah, and I think that's an important point, Ted, is always to follow the money and see who benefits. I remember junior advisor James telling me that when he was in the first grade. If you really want to understand why something is being done, follow the money, see who benefits. And unfortunately, I agree. The lower middle class, they're not going to be seeing a benefit from any of the wealth that's flowing in from higher oil prices. Another question from Rose.
I was just going to make a comment, and Ted actually touched on it. Uh, and it is indeed that even though the United States as a country is going to benefit because of the higher Brent crude oil prices, the majority of the people are not going to see that benefit. And actually, in the aggregate, I think what it's going to cause is that even more widening inequality because we will have sectors of the economy that will inordinately get so much richer because of what's happening and it is indeed the consumer, and it's mostly working class people who are now not able to fill their tank with gas because it's too expensive. We don't have investments in public transportation that would help alleviate that the cost, that expense, additional expense on the working class, and this is where we can see that in terms of the importance of Congress in terms of putting through legislation that will actually address some of these structural inequalities.
It's a, it's a good point, Rose. Ted and I were just commenting on from his southwest corner of Germany. In an hour and a half, he can be in the heart of Paris. Whereas on California freeways, in an hour and a half, I'm still sitting on the California freeway. I may have gone a few miles, but not very far, and certainly not another country. And, Ted, I did want to just bounce back to what you had said about indirect costs. Can you expand a little bit on indirect costs and what does that mean to a consumer? I'd maybe unpack that a little.
Yeah, this is an area that I think potentially has the chance to be actually the larger impact, even greater than the direct costs. And we can explore that a little bit. So just to start with, so the U.S. The war has impacted financial markets in that the market now doesn't expect the Fed to lower interest rates this year. And so, right before the conflict, the market was expecting that later this year, because inflation was projected to go down, that the Fed might lower rates 2 to 3 times. So, that would be between 50 and 75 basis points of rate cuts in 2026. That was what the market was expecting right before the war. And now the market, because of the impact on oil prices and the expected rise of inflation, now it expects the Fed will be on hold. So that's a difference in policy of having the Fed funds rate where it is now at around 360 or 365 versus down around 3%. So it's about a 60 basis point change in terms of the market's expectation for the year ending Fed funds rate. And now, when we think about that, that's going to lead to a higher net interest expense for the US government because the US government has about 25 billion of outstanding debt that's not held at the Fed or in intergovernmental agencies. So we're basically paying interest on that. And if we say we're paying 60 basis points higher interest rate, and that's appropriate because 90% of the Fed's borrowing is done at the very short term level. So it's not long-term borrowing, it's very short term. So this Fed funds rate is appropriate. So if we're paying 60 basis points higher on the 25 trillion of debt, that's going to be 150 billion of additional interest expense as compared to the hypothetical situation that the Fed would have lowered interest rates, by 2 or 3 times this year. So again, I mentioned that this is dependent upon how things progress, but as of right now, we can kind of compare a before the war situation and after, and we get that 150 billion approximately of higher interest rate expense. And when our budget, when Congress is faced with the reality of budget deficits that are higher, then there's more pressure to have less spending on these other areas like healthcare, like Social Security, like Medicare, Medicaid, like these other programs that broadly benefit society. So that's one thing. And then there's actually a second point here, which is that there's something in the bond market called the term premium. And without going into that too much, it's basically the increased yield that investors demand to hold a longer dated bond, a longer dated treasury bond. So, you could expect that if the Fed's going to have interest rates at 3%, then why not have a 10-year Treasury rate of 3%. If the Fed is expected to have that level of interest rates hypothetically for 10 years, then you could have the 10-year yield at 3%. But what actually shows up in practice is that investors say, you know what, I'm not willing to loan my money for 10 years at 3%. I want a premium because I'm giving up my money for a longer period of time. So I want 3.5%, whatever it turns out to be. That term premium that is built into the 10-year yield fluctuates over time. And what's happened is it's actually gone up significantly since the start of the war. And so the 10-year yield is not rising primarily because of inflation expectations rising or Fed policy increasing. It has the longer term Fed funds rate expectation has moved a little, but it's mainly this term premium. And there could be lots of reasons why that term premium is rising. But two of the concerning reasons, which I think are most likely the reason behind its rise, are that investors are becoming more concerned about US debt sustainability because they see this war is evidence that budget deficits are going to widen. There's going to be
Hmm.
more spending. And, if there's any economic slowdown, that means tax receipts are going to go down. So it's
Good point.
evidence of less favorable long-term picture on debt sustainability, therefore giving rise to a higher term premium. It might also be due to concerns about US like global fragmentation, where there's less harmony in the world, and maybe US Treasury debt is not seen as a safe haven.
Mm.
That could be, there's some other reasons as well. But this is unfavorable. And if we have to pay a higher interest rate on longer term bonds through that increased term premium, that affects a lot of things. That affects mortgage rates. 30-year mortgage rate is based upon the 30-year Treasury yield. It impacts all different types of borrowing, higher interest expense, and that
Mm.
feeds into making things more expensive.
Yeah, and I know we were going to chat a little bit about the housing market, but certainly, folks, a higher mortgage interest rate is going to make it, well, the American dream a little bit harder. The idea of being able to afford a home, which certainly in California, home prices are ridiculous. But rather than jump to the housing market, a question from Drake in the Twin Cities about current tariff trends and oil market shocks, if you can speak to that. And then any information you might have on the construction boom of renewables, and of course, the cost of the input, copper, for example. Um, I
Okay,
was
good
listening
questions.
to something
Good
on the
questions.
weekend about copper and how copper prices are going up. Anyway, speak to
Yeah,
that, and maybe you can even tie in AI data centers because copper is needed in there.
yeah. Okay, good. Lots of good questions there. Let's try to run through some of these one by one. So we have a question about tariffs. Tariffs have lifted prices, and the consensus among most economists is that really the impact of those is towards a one-time price increase. So it increases prices one time essentially over the course of about a year or so. Companies have kind of passed along
Yeah.
those price increases gradually, and those started happening May, June of last year. The tariffs went into effect. Most economists believe that that impact on inflation is going to be basically winding down by around the middle of this year. So it's boosted inflation in the near term, but then it doesn't have it increases prices, but then it doesn't have a lasting impact on the inflation rate. And
But
so,
it does have it on the consumer, though, because we're still paying the higher prices. And
sure,
certainly I
sure.
see it at the grocery store. So
Yep,
it's a one
that's right.
time, true, but it's one time and sustained. Would that
That's
be
right.
accurate?
Yep, that's right. And so that impacts affordability, et cetera. leaves less money for other things,
Yeah.
indeed. And then in terms of, okay, the
Yeah, the
impact.
construction boom and renewables. Are you seeing that from the war, Ted, that there would be more emphasis on electric vehicles? We need to be solar. Or are we going to see countries hunker down and say, I need to hold and hog all the oil I can?
I think both are possible. We'll have to see. There's, I think I was going to touch on this point a little bit in the future, but
Mm,
there appears to be a global fragmentation happening. And this is a trend that's been in place, but it's continuing and accelerating with this war, most likely. And that is that countries feel like they have to safeguard their supply chains for themselves. And there's less, it's less appropriate to trust that you can get what you need in terms of your resources from outside the country. So, what is likely is there'll be kind of a hoarding or a reshoring of your supply chains more domestically after this crisis. And that will exist for energy, whether that's through petroleum, carbon-based energy, or if it's through renewable energy. We'll have to see. In a lot of cases, it will probably be some combination of the two. It will be also for other resources like copper, the minerals, etc. So, and in terms of copper and areas like this, what has happened over the last decade or so is that there's been a large underinvestment in new supply. Prices of copper and things were relatively low, and it wasn't
mhm.
economical to bring on new supply. And now there's this surge in demand, and prices have increased, but it takes a long time, for copper instance, for new mines to be built. And you have to see fairly high prices in order for it to be economical for businesses to go down that new investment path to bring supply onto the market. So we could be seeing elevated commodity prices in things like copper, other minerals that are important for semiconductors, batteries, things like that. That could be a reality for many years to come.
Interesting. And Paul had commented about Bangladesh and Pakistan rationing gas. I certainly have seen that, Ted, also in the Philippines. I saw
Mhm.
France's comment about 40% of the oil infrastructure having been destroyed. Again, I'm not the economist or the military expert, but I think these do have ramifications. And to your point, there could be a construction boom in renewables, which Drake is asking about, but it does take time. We can't just slap solar panels together. Um, are we going to see more emphasis on renewables, electric cars? What do you think?
I think in some cases you will. Yeah, where possible. I mean, currently the political environment in the U.S. is
But you remember in the
unfortunately.
70s, Ted, with the big gas guzzler cars and then the OPEC crisis that you mentioned, there the consumer basically said, look, I'm going to go for more fuel efficient cars. Could it be consumer demand instead of government push?
Sure, yeah, and it could be, and also it could be economics because, for instance, for data centers, the
Hmm.
cost to bring on new solar or wind supply is lower than that of coal, and so in the area of the utility providers, they're migrating a lot of their new capacity towards the renewables. So, yes, I think so.
Interesting. Yeah, I've been reading about the data centers and just how much energy they consume. I'll try to find the article in the Atlantic for everyone, which talked about the dirty side of data centers. And yeah, I'm guilty, folks. I've used ChatGPT. I may be the only one here, but guilty. I did not realize what an AI data center consumes and what it does to the environment. Um, and Rose, I saw you had a question, not to ignore you.
Yes, thank you. And I'm hoping Ted probably has this as well as a topic of discussion. And because when you mentioned treasury bills, Ted, uh, it it has been brought up that a lot of the Gulf states have their sovereign wealth fund invested into U.S. government debt, right? And so, with what's going on with the closure of the Strait of Hormuz and the Iranian demand that only the ships that are going to pay the toll in Chinese yuan um, is like I guess a portent of what is going to happen to the petrodollar. And if the petrodollar is threatened, that will impact certainly the sovereign wealth fund and investments into treasury bills. And I just saw this morning that two ships were able to transit through the strait. One went to Japan and one went to France. And so these two allies of the United States would have paid that toll in Chinese yuan. So, uh, uh, what is your perspective on this de-dollarization, and how is it going to impact our participants in terms of our consumers, and yeah, very, very curious about that.
Yeah, okay, good question. So actually, in terms of the de-dollarization idea, I think that's maybe a little overblown in the near term because it's not that likely. But if we get to an increased fragmented world, something like that is possible, like weaponizing treasury sales as a way of getting back at the United States. And that was really, actually, that was talking about the increased term premium because that was an evidence that maybe some of that or concern about that is happening where people don't have as much confidence in US Treasury debt as being a haven that they can rely upon. So that's exactly kind of built into what we were talking about in terms of the term premium. Yeah. And then I think, there's discussions about shortages, and we can
Hmm.
shortages of oil, shortages of helium, fertilizer, and I think the topic of this is not about the economic impacts, it's about the social impacts. But we can briefly get into the
Well,
economic
my
if
thinking though, Ted, on fertilizer, direct input to agriculture, direct input to grocery prices going up. There's my social impact right out of the
yeah,
gate.
that's true. You're right.
I see it as particularly for people who can barely, I think it's the average American can't take a $400 hit. They don't have enough money saved for a $400 emergency. You had just mentioned $280 in higher gas and grocery prices. The fertilizer thing I definitely see. I will say to Whitaker's question though, helium, I'm going to need your insight, Ted, on helium.
Yeah, well, we've
Maybe you can
learned
speak
that.
to both.
Yeah, so I think y- we're learning about the interconnectedness of supply chains and how not having helium could impact semiconductors. And then what does that do for, knock-on industries for your cell phone, for your computer, for data centers, etc. So things are still very connected. And the Strait of Hormuz is a massive channel where we've been getting 20 million barrels per day of oil through there. And if these remain closed, if that strait remains closed and the raw materials don't get out, then you just have shortages. And then that has impacts, pretty massive impacts. And essentially, you get to a situation, if this remains closed, that's resembling somewhat, maybe somewhat like the pandemic, where you just have supply chains that don't work. And so that's the risk if this continues longer. Hopefully, it will get resolved this month because I think as you go, if the calendar turns to May and the oil and natural resources are not flowing, then you're talking about shortages. We're hearing, like you said, about that in some Asian countries, and then it could be more widespread.
Well, and I'm 58, folks, and I am today old that I learned about helium and semiconductors. So, Whitaker, thank you for that question. I did not realize that helium was an inert gas used in semiconductors. But if you drive up the cost of helium, you're driving up inputs, semiconductors go up, and voila, my new computer purchase, which I have been contemplating, subject to my wife's approval, might be something that doesn't quite happen. And all those cell phones, you think about everything that runs on a semiconductor. Again, folks, we could be seeing direct shocks to the economy and to our pocketbooks. Um, yeah, on the we talked a little bit about the rate hikes and mortgages. Anything you would want to say on that? And Rose, I do see you have a question, but given that owning a home is one way to increase wealth, Ted, I'm seeing that the growth, the wealth inequality between those who are renting, those who own a home, I'm seeing that widening with these rate hikes. Would you agree with that?
Yeah, that's true. Of home ownership and home affordability for those entering the market now with mortgage rates around 6.5%. It's much
Mm,
different than pre-pandemic or early pandemic years when rates were 3 or 4.
mm,
And so, yeah, the affordability is a huge issue. It means that home ownership which really does build wealth, it is much more challenged for many people in the United States. And what's the impact of the war? Well, the 30-year fixed mortgage rate has gone from around 6% to 6.5% during this time. So that's
mm,
0.5% increase in
mm.
the 30-year mortgage rate. And if you look at the monthly payment calculation, that means your monthly payment is going to be about 5% higher now with that higher interest rate than it would have been if you were getting it at 6%.
And every dollar counts. Rose and I certainly had a challenging time with buying our first or our second home. And it was really a stretch as we looked at interest rates, down payments, how much could we afford? Yeah, it was challenging. Rose, you wanted to jump in with a question?
Yeah, Ted, what do you see and what do other economists see in terms of the market performance? Timothy had earlier put out the chart about market recovery, but there really hasn't been like a depression in terms, or rather a lowering of when you look at the Dow, for example, but it certainly has been more volatile. And for our participants and for 401ks in particular, these are long-term investments, so it's not speculative. So uh, I'm just kind of wondering, uh, are economists saying that with this war still continuing, is there going to be more volatility? Is there talk about like pump and dump that Trump, the president, is doing with his cronies? And is that something that the economists have talked about?
You talked about volatility and the stock market performance, and I think we have increased volatility a bit. The VIX has gone up to mid 20s, occasionally above 30 in the last month. The S&P had a 9% approximately decline from its peak in January to the low earlier this week on a closing basis. So, it's been moderate. I think maybe the market is kind of expecting that this is somehow resolved because the potential economic catastrophe, if it's not, is just so large that the market believes that somehow intelligent heads are going to figure out a way to get the oil and other things flowing somehow. Um, but we don't know. We don't know. And I don't think anyone really knows when and how it's going to be resolved. So, as a long-term investor, with a long time horizon, you can more or less look through these shocks, and that's good. And so diversification is important. Um, your time horizon is important as well. So those are important things. In terms of what Trump is doing, I don't know. It's tough to know if there's some what the plan is and how that relates to the financial markets. But also, I tend to agree that this is most likely going to be resolved, at least from the flow of oil and resources perspective, without too much longer of a delay, because the Trump administration knows that this is unpopular, knows that if it continues, it's going to drag on their popularity, on the GOP popularity in the midterms. And so they're probably looking for a way out. Also, you've seen talks from Iran and Oman about a pact to kind of safeguard or let the flow of oil come through. So, we'll see. The market has kind of put in a low earlier this week, and we'll have to see if that holds.
We can always hope for cooler heads prevailing, but I'm not so sure about a thought out strategy. Again, Rose can probably pop in some of the talks from Professor Jiang and his comments on why this may not have been the best idea. And it's not just here in the US. Ted, you and I were talking offline about the 900 billion euros that Germany has committed to bolstering its defense. And I would assume that's 900 billion euros being taken away from other programs that the money could be spent on.
Yeah, that's a very good point, Timothy. So about a year ago, when Trump first came into office, or before he was coming into office, and this is within the context of the Russia-Ukraine war and
Mm,
concern in Europe that Russia could expand their march outside of Ukraine to other countries. So there's concern that maybe Europe is not adequately defended, can't trust their NATO allies to safeguard them. And there were direct talks about this from the vice president, who came to Munich and gave a very hawkish speech. And so within that context, Germany said, we're going to massively change our fiscal policy. We're going to spend 900 billion euros over 10 years to increase our defense budget and to increase our infrastructure spending. And this wiped away the German constitutional requirement of not having budget deficits above a certain amount. Um,
wow.
and so it was decades of precedent within the German system of being budget minded
Mhm.
and also having a limited military after World War II. So that's reversed itself. And this is kind of evidence of this more fragmented geopolitical environment where countries have to be concerned about safeguarding their own defense. And what does that mean? It means that if more resources are going to defense, then there's less resources for social programs like healthcare, like education, et cetera, et cetera. So this is the environment that we're existing in, and the Iran war appears to just accelerate that trend, I would say.
Well, and I appreciate Whitaker, the comment on wealth inequality in the US is worse than it was in 1790s France. I don't know if I should start eating cake now or later, but I will think on that. Rose, do you have a comment or a question there?
Yeah, just not being an economist, but obviously very concerned about the state of the economy and what is going to happen to our retirement savings. Do you have any pointers, Ted, for our participants to like what indicators should we look at? What news items would be of particular significance? Because there's a lot of noise out there, and there's a lot of information that are competing and for our attention. So what should we be looking at in terms of what really matters to uh, how it would impact our retirement savings?
That's a good question. So, at a high level, I think having your portfolio allocations match your time horizon, so your asset allocation matching that is really important. And so if your time
Mhm.
horizon is 10, 20 years down the road for when you need the money, then you can look through near-term volatility because it doesn't impact the value of your retirement savings at a future date too much. So that's one thing. Diversification also helps. So if you're well diversified, that means that, baskets of the portfolio that are not doing well now, well, there may be other baskets that are, and those help balance out. Energy stocks are up 33%. So when you've included those in a portfolio, that helps cover for some of the losses in the other areas.
Mm.
Um, I think that also volatility in the markets can be a good time to rebalance. So there's the potential for, well, in retirements accounts, this may not be that important, but in terms of tax loss harvesting, so you
Yeah.
can use these bouts as opportunistic times to tax loss harvest or to rebalance. So that's another possible area. And I think just making decisions, you have to be careful of making emotionally charged decisions. Um, those don't tend to work out well. So that's why the framework of time horizon, asset allocation, diversification is so important because then you're kind of not putting pressure on making a suboptimal decision. And Warren Buffett was famous for saying that it's sell when other people are greedy, or what was the be greedy when other people are fearful, and fearful when others are greedy. Kind of that contrarian perspective.
Very much. Yeah. And I think Peter Lynch with the Magellan Fund said something along those lines. When you're selling, I'm buying, and vice versa.
Mhm.
Ted, we've got about 4 minutes left. Rather than closing thoughts, I just wanted to ask you to get out your crystal ball, give it a quick polish, and what do you see the Middle East looking like? It's great to say maybe the war will be over in 2 to 3 weeks. The damage to that area, I mean,
That's
168 schoolgirls, I don't know how anyone can look at that and say, well, it happened. What do you see the Middle East looking like, Ted? I know this may be a little outside your realm. Take it away.
Oh, it's not that I have some expert opinion on this, but I think it could go in different ways. I mean, you're seeing that Iran appears to have found a way to exert control on the strait that was not apparent before this crisis. So that could embolden them, perhaps. Um, you're also, there's also the potential that this military conflict could drag on longer and there could be more deployment of forces longer term. I think politically that's not very favorable for the Trump administration, but it could if they want to exert a presence over the strait and kind of take that away from Iranian control. So that's possible. I also think, Iran has been, and their proxies and Hezbollah and Hamas and in Palestine, they've kind of been the main opponent of the rest of the Gulf states and of Israel. And if for some reason this does lead to a shift in Iran and in the way they're related to by the other Middle Eastern entities or countries, it could be a place of greater harmony in the future. Um, so I think that's also possible, and we'll just have to see how things develop. It could go in some different ways. At least that's what I've understood to this point.
Well, I appreciate that, Ted. Any last questions, folks? a robust conversation. Like I said, I really wanted to expand this to the social justice side and the impact to the consumer. Too frequently, we focus in the industry on how fast will the market recover. And the market does not necessarily define the health of a consumer. When you look back to COVID, I always said that the markets will recover quickly, and then individual pockets of the economy will recover. People's portfolios will be next, and far behind from COVID would be mental health. I see the same thing here. Markets will recover and keep marching forward. Individual sectors of the economy will start to recover. But the impact to the consumer and those who are directly impacted by the war, those shocks are felt long after the markets have forgotten about this, and I use forgotten in quotes. Anything else, folks? Ted, any final thoughts before we sign off? You're very welcome, Drake. Very welcome there. Anything else, Ted?
No, nothing's coming to mind. I think we had a pretty full
We
coverage
did.
of things there, and I appreciate the opportunity to join you today. And yeah, thank you very much.
Well, thank you,
Thank you,
folks.
Ted.
Be well, everyone. Bye for now, and the recording will go up on YouTube. Thank you. Take care.
Take care.